again, everyone, and welcome to Stockcharts TV. Today is Wednesday, October the 9th. It's about 12 noon in Chicago. I'm John Kosar of Asbury Research. Today I want to talk to you about what I see as a special situation that's starting to develop in the U.S. stock market. The market is at a really important strategic decision point. It's been drifting sideways for the most part since the middle of the summer. It's starting to lean up now, and there's some very attractive risk reward that we're watching. So let's get started by taking a look at the internal condition of the market via the Asbury 6. Those of you who know me through Stockcharts or just around the internet know that the Asbury 6 is our own daily indication of the internal health of the stock market. So let's have a look at the latest reading here. We're going into the research center here at asburyresearch.com. And we're going to the Asbury 6. So the Asbury 6 is comprised of 6 technical and quantitative indicators that we have back-tested as a set that do a really good job of keeping us on the right side of the market so we don't get knocked off of our game by all the daily gyrations that we're seeing in the stock market these days, when the market's up 50 in the morning and it's down 50 at the end of the day. Right now, we can see 5 of the Asbury 6, or 4 of the 6 metrics, constituents that are in the Asbury 6 are currently green, currently positive. They've been 4 or more green since September the 12th, and the S&P 500 has risen by about 3% since then. In order for this to turn red or to turn negative, it would have to turn 4 or more of these would have to be red. So right now, the market is not 100% healthy, but it's mostly healthy according to the Asbury 6. Again, 4 or more constituent metrics in one direction are necessary for a directional signal. This is updated every day about 2 hours after the close here in the research center at asburyresearch.com. Asbury 6 is active by design. It's made to be very sensitive to the internal changes in the market. It has about 11 round turns a year since 2017. That may be too active for some. For us, I want to see that activity. I want to see what's going on underneath the hood of the market, and I want it to be sensitive. Since 2017, it's stayed dead even with the S&P, which is about 12.5% a year annualized. But the difference has been the maximum drawdown by tracking the Asbury 6 has been about 13.6% throughout that whole period since 2017. In the S&P, it's been 34% for maximum drawdown. Now let's move on to some of our stock charts, and let me show you why we're here today. First, let's look at the Nasdaq Composite Index. That is the larger of the 2 Nasdaqs. We're going to look at the other Nasdaq in just a moment, but let's start here by looking at the Comp. The Comp has been in a February 2023 major uptrend. You can see it was tested here. The 200-day moving average, that is the major trend proxy that we're looking at. It tested it again here back at the beginning of August, but this trend has been intact since February of 2023. Once we peaked in the summer, this is the middle of July, the market started to drift sideways. That's what happens when the market becomes overextended, unsure, thinking maybe it went a little bit too far too fast, and we went into the sideways area of investor indecision. Technically, it's called the triangle. It indicates the market's taking a rest. On September the 18th, we broke out of that triangle. That targets an 11% rise from where we are today up to 20,250. What happens if you're wrong? How do you know if you're wrong? If we break down through the 50-day moving average here, which is a minor trend proxy, and the apex of the triangle, they're kind of about the same level. They're converging at about 20,000 or at about 17,390. Above 17,390, the breakout stays intact. It targets an 11% rise to 20,250. So we have some risk reward going on here that's attractive. The next thing we're going to look at is we're going to look at an individual stock that's been making a lot of noise this year. We're going to look at We're looking for NVIDIA. And there we are, going the wrong way. This is NVIDIA. This is daily. This is going back to the beginning of the year. In the beginning of the year, the second week of January, there was an exposition in Las Vegas talking about AI. There were some big announcements made there, and that's what really started this huge move that I'm pointing to right now in NVIDIA. We had this really strong move higher into the high that we made back in June, and then we proceeded to start to grind sideways again. Very similar to the pattern that we saw in the comp. We broke out of this pattern on October the 7th, just a few days ago. Targets are sitting down. It targets a 27% rise to 169.50. So $169 a share. From here, it's going to remain valid as long as we stay up above 120 per share. That's the bottom part of this triangle. This is the support level. So right in here is 120. So again, you've got some risk reward and a big upside target for NVIDIA. We'll see how that transpires over the next few months. But again, the takeaway here is a little bit of risk for a lot of upside. And that's what we look for, these special situations where we can risk a little to make a lot. The next one we're going to look at is we're going to move over to Google. And Google, there's Google. Google is also in a major uptrend according to the 200-day moving average that started in March of 2023. Google, we went all the way back here to 2021 because I wanted to show you the support level. There was an old high that was made here in 2021, another one that was made in the early part of 2022, and that support level is being tested right now. And so we bounced off of the support, and now we're sitting on the 200-day moving average. Again, this chart doesn't tell us either up or down, but it does tell us that we've got some massive support underneath here. So again, you've got some risk reward that is pretty attractive. Google is one of the top 5-6 stocks according to market cap, carries a lot of sway in the marketplace. The next one we're going to look at is we're going to look at Microsoft as we scroll through. And here's Microsoft. Microsoft is also in a 2023 major uptrend as defined again by the 200-day moving average. It's been testing major support here at its uptrend line from January 2023, which is this green dashed line here, and the 200-day moving average since the beginning of August. This is the low that we made on August the 5th. So again, it doesn't tell us which way we're going to go necessarily, but it tells you that this is a big inflection point for Microsoft. Either the uptrend has to re-engage here, or we're going to go into some kind of a significant move lower. The market sees this level. It's been bouncing off of it for almost 3 months. So more potential risk reward opportunity here, just like we've seen in the other ones. NVIDIA, Microsoft, and Google are all linearly correlated to each other and have been for the past 20 to 25 years. In other words, they all move up and down at the same time. So what we can see in one is often going to be what happens with the others. So how NVIDIA handles the triangle, how Microsoft and Google handle these support levels, they're all likely going to relate to each other. Why? Because statistically, they've been moving up and down together for 25 years. The next thing that we want to look at is relative performance. Relative performance to us here at Asbury sometimes is even more important than what we see in the outright chart. So we're going to go to the NDX. And we're going to look at some relative performance here. This is the NDX with its 200-day moving average and 50-day moving average going back to the beginning of the year. You can see it's holding the major uptrend here, and it was tested back in August and a kind of a pseudo test here back in September. The takeaway on this one really is the bottom of this chart. This is the relative performance down in the lower panel of NDX versus the S&P 500 or SPX. You can see that NDX started underperforming SPX right here on July the 25th, and it has kept underperforming while NDX shifted from an uptrend to a sideways trend. Look what's happening here. NDX is starting to make some early indications that it might be re-engaging in terms of relative outperformance versus the S&P. This is a 63-day moving average that we are using here. Why? Because 63 days is a business quarter. That's the quarterly time frame that we like to look at the relative performance. So this is really imperative to NDX going higher, NVIDIA going higher, Microsoft holding its support. Watch this relative performance with NDX versus SPX. We're watching it like a hawk every day. If we start outperforming again in NDX, that's going to give me a lot more confidence that we're going to go higher here on all these various charts, all these indexes and individual stocks that we have looked at so far. The next one we're going to look at is more relative performance. This time we're looking at the SOX index. So we're going to go back through our deck and get to the SOX. And this is the relative performance part of the presentation here that I want to do a little following through on. This is the SOX in the upper panel with the 200-day and the 50-day moving average. Note that it tested its 200-day major support twice, once in August and once in September, held it both times. Now it's starting to move back up above the 50-day moving average, which is the minor trend proxy. That's good on the outright chart. But what I'm more interested in right now is the relative performance chart down here. Again, with the 63-day moving average, relative performance of SOX versus SPX. Note that when the SOX started underperforming here in July, about the middle of July, that's when we got this downdraft in the outright SOX in the upper panel. Look what's happening now. It's been testing this relative performance trend for a couple of weeks, starting to edge above it. The SOX tends to lead the NDX and the comp and the NDX tend to lead the S&P 500. If we start getting quarterly relative performance by SOX versus the S&P 500 over the next few days to few weeks, that's going to give me the confidence that we've got the strength here. So the SOX is going to help our idea and take the market higher. Note back here, all this outperformance that we had from the end of 2023 up until April gave us all of this outright strength in the SOX. That's why this is important. There's one more relative performance chart that we're going to look at, and that is the Dow 30. So let's scroll over there and see how long it takes us to find it in the deck. We're back the other way. All right, so here's the Dow Industrials. Up top, outright chart, 50-day moving average, 200-day moving average, just like the others. At the bottom, we've got the Dow's relative performance. Again, this goes back to January of 2024 versus the S&P 500 again. Unlike the other two, the Dow tends to take the other direction. When the market is strong, the Dow tends to underperform. Why? Because people want to be on the faster horses. Investors want to be in the Nasdaq and in the SOX index. They don't want to be in the Dow when the market's going up. When managers get a little bit nervous and they think the market might be faltering, stalling, it's going to hit a speed bump, that's when you see the Dow start to underperform the S&P. Just like we had here, basically from the end of July through about 2 days ago. Look what's happening now. The Dow is starting to underperform again, just like it underperformed through the first half of this year when the market was so strong. If the Dow continues to underperform the S&P 500 on a quarterly basis, that's going to mean the same to me as seeing the NDX or the SOX outperforming the S&P. So keep an eye on your relative performance relationships here. The next thing we're going to look at is we're going to go to an indicator. We're going to go to the VIX, because the VIX right now is one of the missing ingredients. Here's the VIX. VIX has been very, very choppy, but what we do at the VIX is we overlay a 21-day moving average on it. That's Asbury's tactical time period. That tells us if the market is in a monthly trend of increasing fear or decreasing fear. Right now, for the past 5-6 days, the VIX has been up above the 21-day moving average. When that happens, when the VIX is above the 21-day, it usually puts a drag on the stock market. It doesn't mean the stock market can't tread water or even move a little bit higher, but historically, you're not going to get the kind of move that we are hoping to see, seeing the beginning pieces of. You're not going to get that kind of move if the VIX is above the 21 days. So what we want to see, what I'm focusing on every day, I'm watching where the VIX is. Right now, that 21-day moving average is at about 1787. Let's call it 1790. The VIX is at about 21. We get the VIX down underneath 18. That's going to take that anchor off the back of the market, so to speak. Take that little bit of tactical fear away and allow the market to go higher. The last chart that we're going to look at is just a simple support and resistance chart. I want to know where the support is in the S&P 500 so we know where our risk reward is when we're looking at the broad market. And here it is right here. Here's a 3-month chart of the S&P. This chart begins also right at the beginning of the year, second week of January. And what we want to point out here is where the support is. Primary underlying support is at 5670 to 5652. It encompasses the July and August highs and also the trend line running from the August 5th low. All of these three converge right here. Again, that level is 5670 to 5652. Actually 5637 is where the trend line is. It's moving up several points a day. So that general area, 5670, let's call it 5640. Underneath there is really your risk. If you're saying, I'd like to buy the broad market again, we see these things developing. There could be some risk reward opportunity here. Where do I need to put my stop? How much do I need to risk? That is where I think your risk is right now for new longs. So there it is. The market is at a major decision point leaning upward. Watch the chart patterns I pointed out. Watch closely the relative performance relationships. They're very important. Know where your support levels are in the indexes and stocks that you're trading, and keep a close eye on volatility via the VIX. Now, just a little bit about my firm, Asbury Research. We offer investment research. We have a premium research product that includes all of our models, and we also offer a free newsletter on Substack. That's something new. We also offer asset management, including 4 different portfolios that utilize all of our models in different quantities to get different risk reward profiles. And finally, here's how you can contact us if you'd like to get further information. I hope you found our ideas and analysis useful today. Let's see what happens. It should be an interesting fourth quarter, and we will see you at the next one. Thanks for watching.